Good afternoon, everyone. Thank you all for joining us from your home offices and living room sofas this afternoon for an interactive section with one of our original partners on Deal Square, powered by Neo. I'm joined today by Chris Ambridge, President and CEO of Provisus Wealth Management. Chris, welcome. Thank you for joining us today.
It's my pleasure. Thanks for having me.
You joined us early days, launching PTFs as one of our early adopters on the platform. Perhaps the best way to get us started, if you can share a bit of history about you, about the firm, about Provisus, help get our audience familiar with the mission and vision that you've unfolded over there.
Okay. Well, Provisus has now been in business for 14 years. We're a portfolio manager registered across the country. Typically, we started at the beginning as a separately managed account provider, dealing with MFDA, IROC firms that were looking for managed accounts with third-party stock and bond portfolios. We have approximately 12 of those available as part of our mainline service for clients. And we've just gradually been building up through referral networks with those firms, financial planners, insurance advisors, such that last year we passed through $500 million of money. We only deal in a referral-based world. And over the course of our history, we have rolled out our own investment management expertise, which has been operating with real portfolios now for in excess of 10 years. And over the course of that history, we found that there was a great opportunity to get the portfolios that were normally more for larger based asset accounts into the hands of clients with smaller TFSAs or something else of that nature that would work and give them an enhanced solution. So we created pool funds, corporate class pool funds. Originally 9 different funds have evolved over that period. And it's a very custom proprietary product and solutions, which we'll obviously go into great detail about during the course of the presentation. But as those portfolios matured and the advantages and the value added we built into them was delivered, we started to look at how we could roll those out to a wider audience, not just clients through a direct referral arrangements, but through a platform such as Neo Connect. And that's when the PTFs came about. We've been doing them now for about 2 years, slowly educating advisor community, letting them learn about what we do, how we can bring it to the table, how it can be an on-book solution, how it is an alternative to what they have now, particularly ETFs, which is the place most advisors use them for. And the advantage there, obviously, this is an active product looking for alpha, whereas ETFs are typically passive and generally do not beat a benchmark. So as you go through the conversation and the presentation, those are the points we're going to try and highlight and bring it to the table.
I love it. So a 14-year history, that's actually an incredible part of the journey, and obviously grateful to be a part of it. You're kind of leading the way on that front with PTFs as one of the early adopters. You are a fundamentally different firm, and the way you philosophically think about the investment universe also quite important. I know you brought a presentation along with you. It'd be great if you could take us a bit through the mandate. What really sets you and Provisus apart, I think, is fundamentally how you approach your pay for performance model. Maybe take us through that first and foremost, and then we can take a look at the mandates themselves.
Okay. I'll just give a little background about platform traded funds, PTFs. Obviously, this information is available on our website. Just go to Provisus and type in PTFs, and it'll take you to this page, which has much more information in terms of performance, fact sheets, copies of the OM, everything anybody would need to see and learn is there. But just as a summary, platform traded funds that we have available, really what we're trying to do is create an alternative to passive ETFs. Obviously, this is a huge marketplace, not only in Canada, but around the world. But what we see is with a structured, risk-adjusted portfolio, if you can bring value to the table and charge only for the value you deliver, you have a solution that will resonate not only with clients, but with advisors. So that's what we've created. There is no minimum account size for these purchases. They are traded, the funds are traded once a week. So it's not like there's any discount to NAV or bid-ask spread. Once that price is set at the end of Wednesday, the monies are transferred to our custodian, who is Laurentian Bank, and the monies are held in the client's account name at the brokerage firm. The beauty of PTFs, as you're aware, particularly for portfolio managers, is the ability to bulk trade. Whereas in traditional ETFs, you have to trade on an individual account, or mutual funds, for example, you have to trade and write up the confirms and the details individually. PTFs, you can, as a portfolio manager, you can go across the entire slate of your clients with one trade. Very simple, straightforward process. Won't go into the details for how it operates, but obviously we'd be happy to talk about it further down the road for those advisors that are interested. The thing that we've set our minds to is ETFs, well, they are inexpensive. The typical equity ETF in this country averages 34 basis points in cost. What we've said is, well, let's charge a zero. Let's charge a zero MER. What we will do is take a performance fee on the value added or the alpha we deliver. For clients, for advisors, we put this in a managed account solution. It's crystal clear. The advisor is earning their fee for the service they deliver. We earn our fee for the value we bring to the table. Fair for clients, fair for advisors, simple, straightforward. We don't do our job, don't pay us.
I think that's an incredible message to be able to leave behind, and frankly, a bit of a rarity in the asset management industry, where you are truly aligned with your client all the way through. And in fact, you're putting your money where your mouth is. You're saying, if we don't deliver, we won't charge you. And I think that's something very, very unique, ultimately, when you're speaking with both the advisor channel and they in turn are speaking with their clients. Obviously the PTF vehicle makes that delivery a bit more efficient as well, probably solves a few challenges for the advisor community along the way. It makes you attractive for SMAs or other managed platforms. It also means the advisors can get on with doing what they need to do for their day, which is managing their clients and not dealing with allocations and executions. Thinking about the advisors, how has that conversation evolved? I'm sure pay for performance being a great message and the ability to deliver it. Where do you find that the conversation tends to go from there? Do people kind of look at you and wonder, this is too good to be true? How does that conversation go?
We get that comment a lot. Are you guys crazy? How can you do this? How can you succeed? We know active management traditionally doesn't add value. It's been proven left, right, and center. And really the easiest way is just to show them the results, how it's been achieved. We'll go through extensive conversations about how the approach is working. We don't use leverage. We don't use derivatives. This is a plain vanilla portfolio as the underlying holdings in the funds. We don't go short. It's all pure, very specific funds that are really not any sort of aggregate and tomfoolery. For example, how many ETFs or funds do you have out there that say they're Canadian equity, and yet 35% are US stocks? Or I've seen Canadian equity funds with Israeli stocks in it. So we don't get into that. These are clear, well documented, well managed, well risk controlled. And as you see by the current slide, it's a zero MER. How we get the money in our pay for performance is we take 20% of the excess performance over a well documented benchmark. So it's not a hurdle rate, it's not a high water mark, it's a true benchmark, a total return benchmark. So the Canadian fund, it is TSX Total Return Index, the US S&P 500, international fund, MSCI EAFE Total Return Index. So if we beat that, we take 20% of the outperformance. If we underperform that benchmark, we get zero. Obviously, the question then they ask is, well, how do you stay in business? Well, because we generate performance. Last year we achieved record assets across the business and in these pool funds. I think the funds are over $200 million in aggregate across all our platforms. So we obviously are doing something right. We keep the costs down, and we're allowed to continue to operate and keep the lights going. Just to give you a flavor that I put my money where my mouth is, this is the performance for the Canadian equity PTF. Obviously, the PTFs have only been around for 2 years. The funds have been around for longer. So as you can see, the blue dot, which is the performance for this fund, is done quite well relative to the green dot, which is the benchmark, TSX, Total Return Index, and versus the competition. So these are a aggregate of pool funds across the country. So as you can see, 5-year, 7-year, 10-year, we are the #1 performing Canadian equity fund manager in the country. Speaks to itself. That's how we get paid, because we add value and continuously add value for clients. Just to spread this around again, in the US, similar sort of structure. We're first quartile performer, not quite as good as the Canadian. The 10-year level, we're the 10th best Canadian US equity manager in the country. Should point out these are performance in Canadian dollar terms, just for consistency, so the benchmarks may not jive with what most people would see on a US-based portfolio. And finally, just to show that we're just not North American bound, these are our international portfolios or international PTFs. Same sort of structure. First quartile, value-added performance. That's what we bring to the table. That's how we get paid. And that's how hopefully advisors will come to look at the value added we deliver relative to an ETF or more traditional portfolios.
So just if I'm clear, you're telling me if that blue dot is below the green dot, the fee is 0.
The fee is 0.
That's incredible. And obviously the fact that the blue dot is so nicely above the green dot, it speaks words to everything you're sharing with us now. That's the value you're delivering for the client portfolio. I'm a visual learner myself, so having a picture there to kind of inform that view, very, very helpful. And obviously you guys have done an incredible job already. Congrats on the years behind you. Hopefully the future is as kind.
Hope so too. I mean, what we have, just to summarize for people, last slide, and then we'll let it go. As I say, there's currently 6 different core funds, a series of fund of funds, no high water mark, no hurdle rate. Distributions we try to keep to a minimum. They can be denominated in US dollars for those that are foreign denominated stocks. It's all held on our custodian, Laurentian Bank, and it's a very simple, straightforward process.
When you've got something there for everyone. I see, all the traditional core products in place that you would otherwise expect an advisor to be looking for when building out their book. If you're looking at the lineup, you've got 9 of them today. Which one has been the most topical through 2020, and which one, if it's not the same one, is giving you a lot of conversational room through 2021? Because we're certainly in, I'd say, unprecedented market conditions still. I'm curious to hear about your thoughts there.
I think it just rotates, a bit of the flavor of the month. Obviously, real estate is getting a bit more traction right now, simply because they got beaten up so badly last year that not only is it a bit of a value play, but if the economy turns around and COVID is finally suppressed in any meaningful way, then that should bounce back quite nicely. The one that I think is quite appealing to a lot of people, particularly where interest rates are right now, is the multi-strategy high yield fixed income. And this is a fund that is impossible to replicate through a prospectus-based vehicle because of what we can put into it. So not only does this have the liquidity of a normal ETF, for example, in terms of trading, because we do hold corporate bonds and liquid ETFs, particularly floating rate ETFs, but it also includes mix, mortgage investments, high yield fixed income hedge funds, private credit investments. So you're getting this higher yield solution with no added risk, because there's no leverage or um, uh, derivative-based investments here. So this is a portfolio that traditionally yields between 3 to 5% and with very little volatility, giving clients alternative, whether it's a cash, GIC, or even bonds. Bonds in particular, for example, bonds are almost down 2% this year on an absolute basis, whereas this bond is up about 1%. It makes a fair degree of difference to clients. Just that, straightforward solution that isn't available unless they have another OM-based alternative. So that one we find is picking up a pretty big traction, particularly as we're seeing more and more clients are getting skittish because of the volatility, certainly over the past week, and the record highs is scaring people away, wondering when the shoe will drop. I don't necessarily think it's in the next horizon. Sometimes it's a matter of talking clients off the ledge and saying, we're in the beginning of something new. This is probably an economic resurgence. Valuations are not extreme, certainly in Canada. Even if you look at the United States, of course, they're high, but not in territory that would make me frightened or running into the street screaming. So you're going to stay in equities. And equities, you should bring something to the table. And if you can add value as an advisor to help offset your fee, this should be an excellent solution.
It's quite compelling, and the part that I would suggest is also unique for OM funds, especially some as esoteric, perhaps as you're mentioning the high yield space. The fact that you've got weekly liquidity on these mandates, I think quite a good many of them are usually running monthly or even longer cycles for clients who may need liquidity on a shorter term basis, both to come in and potentially to exit as well. I think those are interesting points to highlight and bring forward within the advisor community as well.
Well, I'm going to shut down the screen here so I don't have that.
By all means. Yeah, I think we've covered the material, and that's also a good overview for our audience today as well, just so they can kind of see, Provisus as a firm, you've got something literally for every part of the advisor book, and certainly a very compelling operating model that I think should be getting more and more attention in the years ahead, especially as advisors start looking at fees and where those start showing up in their book and how they get pushed through to clients, and what we as end investors ultimately pay for as value for your money within the advisor business. Chris, you guys have been on the street for 14 years. What else have you found has come up? What's something maybe that, our audience hasn't heard from you yet already, but that you would want to share with them that's topical today?
The thing I like to emphasize, particularly as we're trying with the PTFs to be an alternative to ETFs, clearly there are ETFs that are very low in cost. But that's just the tip of the iceberg in terms of the MER. There are a lot of things across the ETF universe where, whether it's bid-ask spread, tracking differences, difference between the NAV, these are additional costs that most clients and advisors should be cognizant of. I mean, they do add up. And if you are trying to add value to your clients, or however you're structuring your portfolio, for example, if you have a core and strategy or core and satellite strategy, you want to have something that just doesn't sit there. Maybe you do want the passive portfolio, but wouldn't it be nice to add an extra 50 or 90 basis points every year with no incremental cost to the clients? That's the thing that we see is appealing. That's why we structured it. No, we're not insane. We can actually add value. We've proven it. The results are there. And although I didn't show it from a risk perspective, we do this on a risk-adjusted basis that is actually less risk than the benchmark. So for clients, it's the best of both worlds. For advisors, they pick and choose, do something for their clients that is unique, that they can bring to the table. Not a lot of advisors are obviously doing this. If you as an advisor or through your shop can deliver something that the guy down the street can't, well, not only is it a competitive advantage for performance, you can bring some more clients too. So
Certainly,
that's
it's
right.
another quiver in your well, it's another arrow in your quiver, I should say, that you can leverage to attract more clients into your book, manage your book a little more efficiently. And I think with all the tools available these days, this is certainly a compelling reason to take a look and consider the Provisus lineup as one of those capabilities to improve the overall offering. Curious question, looking at where your discussions have gone over the course of the year, and we're sitting now at the middle of February, which is a bit scary when you think about it. If you were to make a prediction ultimately on the road ahead and where, you're maybe putting your investment dollars, never mind what your clients are seeing. You mentioned real estate for the tail end of last year into now. If you had to make a bit of a bet on where you thought the markets were going to head in the next 6 months or a year through 2021, where are you looking? What are you seeing as the kind of attractive move over the next couple of months?
Well, in actuality, I've just put all my new liquid cash, well, big time, into the PTFs or into our funds directly. The reason being is I tend to own them all through a diverse portfolio. They all have value. Some win, some don't win. But spreading it around on a more, I would say, growth-orientated, balanced portfolio. Quite happy with the emerging markets. It's a very tough area to get access to. You just have to look at what's happened in the United States recently with them declaring quite a few stocks, particularly in the ADR world, to be persona non grata. Getting the access to that diversification at a reasonable cost is unique. So like that, global real estate, it's a bit choppy right now, but if you look at it, the ones that have been beaten up the most are actually starting to recover, particularly in the United States, where you're seeing offices, buildings starting to come back. Don't want to discount the downside because, I think the equity markets are going to be up this year. I'm not shooting for the stars. I think this is more going to be a traditional, hopefully 6 to 9% on the equity markets. I'll be quite happy with that, certainly given where we come. And given that interest rates are starting to back up on the long end of the curve, there's not a lot of alternatives out there. So seeking some sort of growth, and it's going to have to be growth. I mean, there was a bit of a twist at the end of the year last year where value managers had a little bit of a surge. Didn't help them over the course of the entire year because some of the value managers' performance was less than stellar, shall we say. Unfortunately, that has reversed itself again early this year, where value is underperforming. From the PTF's perspective, we're agnostic. We don't concern ourselves with growth or value. We concern ourselves with immunizing the risk of the portfolio. So we don't take bets on sectors. We don't take bets on value growth. We don't take bets on yield or any of that stuff. We are risk neutral. Where we add value is very simple: stock picking. You find your winners, use the models and the technology that we've developed, custom developed, I should say, and buy winners, sell losers. It tends to be a bit more of a high turnover, but the advantage is the turnover are stocks that didn't win out, didn't work. So they're losses. So we're harvesting losses that turn into tax advantages. The pool funds that are coming up to their 10th anniversary this June, I would say we have had, even though we've had stellar results in an absolute world, we've only distributed to clients probably 3 years of realized capital gains because we've been sheltering it. So not only do we do excellent performance, we do it on a tax efficient basis, which is something a lot of people don't look at because, oh, I got lots of performance. Oh, there's a big dividend or distribution coming my way. Hello, Mr. CRA.
That's actually a very good point. And as you start looking at the details of portfolio performance, it's something that you'll always have, it seems, as a bit of an advantage. And ultimately, they're able to connect with you, learn more, get into the weeds on those portfolios themselves, and figure out how they can most efficiently integrate those into the book for client positions as a whole. I love it. You know, Chris, I think the other thing perhaps, and it's maybe something we'll have to check in with you on for our next session after that 10-year anniversary window as well. I'm sure there'll be a few other good updates to hear from. But to our audience as well, you've heard a lot of good information from Chris today about the innovative way that they've been building their business, aligned ultimately with the success of their clients. I can tell you this is something incredibly unique from my chair here at NEO. We see a lot of very interesting listed product, private product, mutual funds, OM funds, and the like, and seeing a pay for performance model deliver with a pretty great history for Chris and the Provisus team going back 10 plus years. It's not something you see every day. We've spent 30 minutes now over your lunch break hearing a bit about their unique approach to wealth management. At the end of it, Chris and his team have a very clear strategy for their business going forward. Not only that, a history behind them to stand upon. Their lineup of 9 PTFs are available on DealSquare. You've got the link in the chat box. And Chris, unless you tell me otherwise, I'm sure our audience is more than welcome to reach out to you directly with any questions or inquiries they may have. Separately, feel free to reach out to the NEO team as well. We're always happy to connect the dots and make sure you get channeled into the right folks on Chris and Chris's team. We thank you all for joining us. Chris, thank you for your time over lunch and for sharing the journey for Provisus, your endeavors with PTFs. We're obviously very excited. I think your future's bright, and we're keen to see where 2021 takes you. Thank you very much for your time.
My pleasure. Thank you for allowing me to speak.
Certainly. And to our audience, thank you for joining us today. We will send you right back on time to lunch. Be safe, stay well, and we look forward to seeing you for another update on DealSquare and some of the unique and fun things we're bringing out to market in the weeks and months ahead. Take care, be safe.